So, welcome back to the third video on Chapter 1. And we're going to look at, in this video, what caused the financial crisis of 2008. And one of the primary things that caused that meltdown was something called securitization. So, securitization right here was when it became fashionable for banks to package a group of mortgages together and sell them in pools. So before that, companies would hold a mortgage. So when you go to borrow money for a home, the bank in the previous to the financial crisis you would pay the bank and they would service that loan. Well, when securitization became fashionable, institutions would would put a lot of mortgages together and sell them in the financial markets. By the way, Fannie Mae and Freddie Mac are called government-sponsored enterprises. They're not owned by the government, but they're backed by the government. And so under President, the first Bush, George Bush, Congress changed the rules for Fannie Mae and Freddie Mac that ended up encouraging them to make. They were trying to make loans more available to people more economically challenged. They wanted to make sure lower income folks could buy a home, and so the result of that requirement on Fannie and Freddie made them expand their underwriting practices so that they would approve loans that previously would not be approved. I'm getting a little bit ahead here. So the point of this slide is that the old way was that banks would hold mortgages and service them, collect your payment each month from the homeowner. And when securitization became the common practice, then mortgages were pooled and the pool was sold, and another entity, perhaps the bank that made the loan may service the loan, collect the payments, but it was owned, that pool of mortgages was securitized, bundled, and sold in the markets, and the issuing bank that made the mortgage may service it, or which means collect the payments each month and remit them, or even the servicing was sometimes outsourced as well. So this slide explains how securitization actually happens. And how the loan process happens today. That a homeowner wants to borrow money for a house, in this case $100,000. There's an originator that could be a mortgage broker, a mortgage broker brokerage company, or a bank. And then they go through. The loan would go to an agency like Fannie or Freddie Mac, would be approved by their underwriting guidelines. So they would set the rules of how you have to qualify for a loan. These GSEs would do that. Then they were pooled, a group of mortgages pooled, and there's an investor that would invest in that pool of mortgages. So this little graphic explains how the money flows at the top. This is principal and interest then, plus a small fee for collecting that mortgage payment each month, moves through the channel. The servicing fee is of course goes to whatever company collects the mortgages, sends out late notices and so forth, and sends the principal and interest on to the investor. So here's what happened during securitization. That the pressure to make loans to would-be homeowners with weaker credit pressured banks and Fannie and Freddie. It pressured Fannie and Freddie to change their underwriting guidelines to approve what's called subprime loans. Okay, so these are loans that are non-conforming. So non-conforming means that the loan, the applicant for the new home loan did not conform to the underwriting guidelines of Fannie and Freddie. So we began to see subprime loans approved, and that included no documentation loans. I actually owned a mortgage company during this period, and these low doc or no doc loans meant you may not have to verify your income. You might not have to verify your rental history. The underwriter would simply take your word on the application for how much you earned, what your payment history had been. And of course, when that happens, unscrupulous people will put down anything in order to get approved. Sometimes even led by the mortgage company. There were unscrupulous mortgage companies around the country. South Florida was known for it, the Miami area, for just writing the application so it would be approved. And then loan to value ratios were rising. Loan to value. So we have a $100,000 house, a home that appraises for 100. At one time, the underwriting guidelines required that the loan would be no more than 80% of the value, the loan to value. So they would loan 80,000, 80% of 100. The applicant had to come up with 20,000. Well, that rose to 90% to 97%, all the way to 100%, where borrowers could borrow the full value of the home. So when that happens, a homeowner has no skin in the game. They've got nothing to lose if they decide, look, the plumbing's bad, I don't like this house, I'm leaving. I haven't put any money into it because the lender provided 100% of the financing. So you can see how that would cause more foreclosures, right? So anyway, these first three were really, in my view, the main issues here that caused a lot of mortgages to no longer be paid. People stopped paying or got late on their mortgages during that era. So that was these three changes in underwriting guidelines that, again, went back to Congress pressuring Fannie Mae and Freddie Mac to make loans available to more people lower on the socioeconomic scale, that sometimes, obviously, they're lower on the socioeconomic scale, let's say economic scale. They don't have the means and have to pay for things to the level of those higher on the economic scale, right? Lower income folks, that sort of thing. So anyway, obviously that was a recipe for higher default rates, and that's exactly what happened. You can see here, this is called the Case-Shiller Index, been maintained for many years by a guy named Robert Shiller and another guy, Case, I don't recall his first name, that averages the house prices. I think it's in the top 25 metropolitan markets in the United States. And you can see how during, after 2000, the market started doing very well, the stock market, and I'm not sure if that was related to house prices going up, but the economy did very well. And prices went very high, and you can see how they peaked here around 2006, 2007 during this area, and that's when the financial market, beginning with the collapse of the mortgage market, that's when that all fell apart and house prices fell. In the late 80s, a new twist came along called collateralized debt obligations, CDOs, which split a group of mortgages into what was called tranches. And those tranches would, so the way they were designed was the top tranche would have the lowest default rate, and the lower tranche would absorb the risk. So the idea was, say that the top tranche would be expected to receive payment as long as the default rate stayed below a certain level. And the lower tranche would accept the risk that if the default rate, as it creeped up, they would take the losses. And the rating agencies, there are agencies that rate the quality of each tranche, were kind of flawed because the issuers of these pools of mortgages were paying the rating agencies. That's how they survived. The agencies had to be paid. And of course, the issuers wanted higher ratings. So when more and more people began to not pay their mortgage, even the AAA tranche began to not receive full payment interest and principal on their loans. So that was one of the causes of this financial crisis and the meltdown. So the point of that, along with credit default swaps, was that the illusion was created that there was less risk in mortgage-backed securities than actually existed. So credit default swaps was where companies, insurance companies like AIG, would issue insurance that if there was a default, they would make the investor whole, a default on this pool of mortgages, right? And if the AAA tranche had losses, AIG would make them whole. The problem was issuers were selling way more insurance than they had capital to back up. So that when there were just much higher levels of defaults on mortgages than was anticipated, the insurance companies did not have the funds to rescue the investors. So the credit default swaps were another kind of actor or contributing factor in causing the financial meltdown. So another important concept around the financial crisis is this idea of systemic risk. And systemic risk is, you may know, is risk that may spread throughout an entire economy and affect the whole country, affect everybody and all businesses. So a financial meltdown has that capacity. And so the government, particularly the Federal Reserve and the Treasury, monitors for systematic or systemic risk in the economy and tries to safeguard against those. So as the financial meltdown began to occur, the government began to get involved. So in September 7th of 08, you can see here that Fannie and Freddie were put into conservatorship. That means the government, particularly kind of led by the Treasury, began to take ownership of the problems at Fannie and Freddie and promised to support them with capital. And we had financial institutions begin to fail. Lehman Brothers filed for bankruptcy. Merrill Lynch was absorbed, an engineered takeover by Bank of America in order to protect their investors. Because this could have been a domino effect that could have been more than a ripple, a tidal wave throughout our entire economy. And that was the risk that the government wanted to protect against. They lent money to AIG. So the government began to respond then to what was going on in the economy. This is a chart of the TED spread, which is the difference between the LIBOR, which is an interest rate between banks, and the 3-month Treasury bill rate, which you know is known as the risk-free investment. So you can see that the spread between those, so this really is a reflection of credit risk, okay? Because we have no risk of credit default in the Treasury bill, and there is credit risk reflected in the LIBOR rate. So you can just see in 08, July of 08, along in this area here, that spread went up because the fear of defaults went up dramatically during that time. So a result of the financial crisis was the Dodd-Frank Act. And Dodd-Frank essentially made banks more conservative, required them to be more conservative. It required them to have keep more capital, more cash versus the more cash versus the amount of risk they were taking. They had more liquidity, keep more cash equivalents. And another result of this Dodd-Frank Act was the Volcker Rule. And the Volcker Rule limited proprietary trading, like I was talking about in an earlier video. It did not allow, it made it illegal against the regulation for banks to trade on their own account, because Congress was taking the position that that created more risk in the system for because proprietary trading is very risky. So they were trying to make banks less risky with Dodd-Frank and protect the financial system more. So even though we've had a number of things happen throughout history, including the financial meltdown in '08, and you can see on this slide what happened to the markets here in '08. It was really tough. You know, I knew people during that time that were about to retire in '08, and they had to work several years longer because their retirement account had dropped so much, right? So the reason that returns have averaged 12% in the market over a long period of time is because we accept that risk. So you could invest your money in treasury bills and earn 2%, or you can accept this volatility here, right? The up and downs of the market. But over the long haul, you should do very well. So do not be scared out of investing in the market. Your 401ks, pension plans are a great place to invest because investors typically do not buy and sell as much in those accounts, and they don't react to the fear that comes along during times like this. So my suggestion is, when you put money in the market as a young person, to set it and forget it, leave it, let it grow, and invest passively into index funds like SPY I mentioned earlier, or technology funds, but into broadly diversified exchange traded funds, ETFs, or mutual funds. So, and over the long haul, you should do well. So we're going to stop here for chapter 1, conclude this. Thanks for tagging along, and I'll see you in the next video on chapter 2. In the meantime, I want you to remember your path to success financially is to spend less than you earn and save the rest. Invest it carefully, and if you do those things, you'll have a good chance at retiring early. So I'll see you next time.